Now we'll come to the complex security, that is CMO or collateralized mortgage obligation. Okay. In collateralized mortgage obligation, what you have is like you can have a mortgage pool or you can have a pool of mortgage pass through. Okay. So in this case what you have is, let's say you have a pool of mortgage pass through plus you have pool of small loans. Okay. Out of this, what is done is you create not one bond but multiple bond. Okay. So what is being created is, there are three type of bonds which are created. Typically these are called as tranches. So you have one tranche, you have second tranche, you have third tranche. So three type of bonds are created out of this pool. Okay. So these, and from this tranche a bond is created. So a bond A is created from the tranche B, a bond tranche 1, and a bond B is created out of tranche 2. So what is the characteristics of this tranche? Okay. So whatever interest payment is received, so this pool will give interest payment plus principal payment. Okay. So all the tranches will receive interest payment as per their principal or whatever the investment is there. But the tranche 1 will get all the principal payment from this pool until the tranche 1 principal payment is paid off. Okay. So what will happen is, this tranche is having the shortest maturity, because with every payment you will have interest and principal, and tranche 1 will get interest plus principal. So interest, all these three tranches get, so interest is being received by all these three tranches, but principal in the starting will go only to the first tranche. Okay. Once this tranche principal is paid, principal will start going to the second tranche. Once the second tranche principal is paid, principal will start going to the third tranche. Okay. In this way what happens is, for this type of investor the default risk is very less, because they will get all the principal first before these guys can get. As a result, the bond issued out of tranche 1 will have a higher credit rating. So bond A will have a higher credit rating than bond B. Okay. So higher credit rating, so bond A will yield lesser. Also the maturity of tranche A will be lesser, because the moment the principal is paid, the bond A cease to exist. The moment principal is received from B, which will be after this, it cease to exist. Okay, so maturity of B will be more than maturity of A. So the tranche 3 will have the highest maturity. Typically, tranche 3 does not issue bond. What it is called is equity tranche. Okay, that is whoever originates this, whoever structure this process or whoever creates these tranches, they will take the ownership in this equity. If you consider, the risk is most in the equity tranche, because if there is a default, this will suffer the most, because they will get the principal payment first and last is this tranche. So the risk in the equity tranche is the most, and this is the longest maturity tranche. Okay. So in this case what we can say is, whatever prepayment was coming, equity tranche was not getting the prepayment. The prepayment was absorbed by the tranche A. So the tranche A has the, tranche 1, sorry. So the tranche 1 has the highest prepayment risk. So what we can say is, CMO, it distribute the prepayment risk. But if you see the overall risk, it does not change. So overall risk, if you combine the risk of 1, 2 and 3 combined, it remains the same. So there is no way you can change the overall risk. Otherwise people will start creating and decrease the risk of some investment, which is not possible. Okay. So depending on the investors, so typically people who are highly speculative, or who they will invest in equity securities, people who are looking in for safe investment will go in for investment in bond A. If you see CMOs one of the culprit of the recent crisis that we saw. People had invested in tranche 1 securities or bond A considering that these are safe, but what happened is they also suffered from loss. So if the entire mortgage pool is, let's say, $100 million, so tranche 1 will have, let's say, $60 million, tranche B will have $30 million, and tranche 3 will have $10 million investment. Okay, so if there is a loss of $30 million, okay, so tranche A will get its 60 million back and tranche B will get only 10 million. 30 million will be lost. So 10 million is a loss of this and 20 million is a loss of this. But what happened was there was loss more than $40 million. Okay, so if the loss is, let's say, $50 million, so this guy will lose entirely, this guy will lose entirely, but this tranche will lose $10 million. So they will lose $10 million, but typically these were rated as AAA security. That is, probability is very low, but still there were losses. Okay. Now another type of bond issued by government or state or local government, these are called as municipal bonds. Okay, typically these bonds are issued to finance some projects. Okay, because these state and local government, they go into road building and other projects, so they issue bonds, and whatever the revenue is being received from these projects, they are giving back to the investor. Some are backed by the project revenue and some are backed by the government revenue. Now most of these bonds pay very low yield. Okay, but to entice the investors, what they do is they make it tax exempt. So if let's say Arizona state has issued a bond, it will make it tax exempt in their own state. But what happens is, but California will tax that bond. Okay, some of these bonds are also exempt from tax central level or federal level. Okay, so when it is being exempt from the federal tax also, these are called as double tax free bond. That is, the owner of those bonds do not have to pay state tax as well as federal tax, because in US you have state as well as federal tax. Okay, typically these bonds can be revenue bonds or it can be backed by the tax. Okay, so these are called as tax backed bond or general obligation bond. Okay, you have like different varieties in this. You have limited tax debt, that is, whatever the revenue from tax is there, it will be paid back, but the government or the municipality will not increase the tax to pay to the investor. In contrast, you have unlimited tax debt wherein the tax rate can be increased. Okay, some of these bonds are called as double barrel bond. Okay, appreciation backed obligation. Okay, debts with support of public credit enhancement. So these are like some of these bonds which are tax backed bond. Okay, you have revenue bond, that is, these are backed by the project revenue. Okay, some of these bonds are insured. These bonds are insured using a third party guarantee. When you insure something, what happens is the credit rating or the rating by the rating agencies increases, because let's say if they're making a bridge and they have issued a bond, but they feel that the revenue from the bridge will not be much, so they will insure the bond. This will mean that if there is not much revenue, what will happen is the insurance company will pay, or if there is some default, the insurance company will pay. So as a result, that credit rating increases and many different type of investors can invest in those bonds. Some bonds are pre-funded bonds. In this, what the municipality or the state government does is to pay for the coupon and the face value. They will from the cash they have, from the cash reserve, they will buy the treasury security, that is a government security, and it will pay the coupon and the face value from those. Since the investment is done in treasury security, these pre-funded bonds receive a high credit rating. AAA rating is very common in these pre-funded bonds. Okay. Similar to municipality or government, you have corporation issuing various type of bonds. Okay, these bonds are issued to finance their day-to-day operations. Okay, you can have secured debt, that is the debt which are backed by collaterals. The collaterals can be their land, machinery, their cash reserve, etc. Okay, the bonds can be unsecured also. These are not backed by collaterals. Okay, these unsecured debt which we have seen, like debenture is one kind of unsecured debt. Okay, typically why they will issue unsecured debt? Because the secured bond holders, they specify in their indenture that no, you cannot issue debt above this. Okay, so they will issue unsecured debt, but to entice the investor they will go in for credit enhancement technique, like going with a third party guarantee, going with insurance. Okay, so this will increase the credit enhancement. This will increase the rating as well, so various type of investors can invest in this. Also there have been issue of medium term notes. Okay, in this what the corporation does is it takes a permission from the Fed that okay, we will be issuing this much of bond, so they will go in for a shelf registration, and out of that, like for let's say they have taken the shelf registration for 5 years, and each year they will be issuing some of these bonds. So registration is done only once. Okay, typically what happens is these MTN are combined with derivatives. Okay, so they are combined with derivatives to create floating securities, and these are called as structured notes. Okay, when they are MTN or medium term notes are combined with derivatives, it will create structured notes. You can have step up notes, that is the coupon payment will increase once or more. You can have inverse floaters. Okay, that is as the floating rate increases the coupon decreases. You have dual index floaters, that is it will be indexed on two reference entities. Okay, you have deleveraged floaters. Okay, what will happen is these have lower duration. You have range notes, you have index amortizing notes. So these are the different type of structured notes that are created. Now this corporation issue lot of bonds which are called as commercial paper. These are zero coupon bonds. So these commercial papers are zero coupon bonds, so typically they are issued at a discount. Okay, commercial papers, the requirement is not stringent, and only big investors invest in these bonds. So big investors like asset management funds, etc., invest. So the rate that the issuance of this commercial paper brings in is lesser, so it benefits the corporates. Okay, also corporate issue what is called as certificate of deposits. It is similar to the fixed deposits that are given by the banks. These certificate of deposits have higher rate of interest than commercial papers. Most of the time smaller investors, they will invest in this certificate of deposits. Okay. Now we'll come to asset-backed securities. These asset-backed securities are similar to mortgage-backed securities. Only in this case, these assets are the loans which are not mortgage loans. So these various loans are credit card loans, vehicle loan or automobile loan, education loan, etc. Again, in this you have a securitization process. In this also you have a mortgage pool. So you have a mortgage pool of various loans. So this mortgage pool is being constructed by a let's say a bank. Okay, so what the bank will do is it will create what is called as SPV or special purpose vehicle. This special purpose vehicle owns this mortgage, it owns this pool. Okay, and from this pool they will create a pass-through security. They can issue similar to collateralized mortgage obligation. They will issue what is called as CDOs. Okay. Now, if you see this type of loans, most of the loans are taken by the retail investors. So there is a risk of default in these loans. So what is being done is credit enhancement. So in credit enhancement, what they do is they give guarantee from the corporate. So it might happen that these banks give guarantee for this. Also, they can get guarantee from some third party. Okay. Now the purpose of creating this SPV is that if this SPV goes bankrupt, it will not impact this bank. So this SPV create what is called as bankruptcy remote entity. So the bankruptcy of the bankruptcy of this bank will not impact SPV. As a result, what will happen is that uh, the rating that is received is more. Okay, so the rating can be done through corporate guarantee, it can be done through letter of credit from some other bank, or they can go in for bond insurance. All this is done, SPV is done, and all this credit enhancement is done to make this more attractive to pension funds, etc., because these pension funds, etc., invest in only highly rated security. Okay, again, what is being done is you can issue a plain vanilla pass-through security, but most of the time CDOs are created. So CDOs also you have, similar to CMO, what is being done is out of this pool various tranches are created, and so you have tranche 1, 2, 3, and these tranches will issue bonds to the investor. Okay, so these different tranches have different cash flow, because depending on that, tranche 1 will receive the principal payment first, so it will be paid off first. So as a result, they will have different credit ratings. Okay, this is very much similar to the CMO that we saw. Okay, now we'll come to the last thing in this reading, that is the mechanism of bond issue. Okay, similar to equity market, bonds have primary market, bonds have secondary market, bonds are traded in OTC market, bonds are traded in ECNs. Okay, you have underwriters also in the bond issue. When you have what is called as firm commitment, that is underwriter takes all the risk, that is the I banks who underwrite the issue takes all the risk of issuing the bond at a particular price. They can go in for a best effort basis, wherein whatever amount of bond is sold, it is being sold, and underwriter or the iBank does not take any risk in that. You can have an auction process. In this, what happens is there is not one bank which is taking part in the issue, but you will have a syndicate of banks which are taking part in the issue, and from this syndicate, this syndicate will buy the bonds. Okay, you whenever bond is being issued, they have to get registered, but company can do a private placement where the bond is only placed to very high net worth institution or big institutions or high net worth individuals. In this case, the registration of the bond is not required. This will result in lower cost to the issuer. Okay, so it's like similar to the equity market, you have this bond issue also.